Flight Centre is one stock I know that you're having a look at today, the profit guidance today. What do you make of the announcement and the key drivers?
If we have a look at Flight Centre, it's quite an interesting stock, and if we just have a look at the share price of Flight Centre over the past year, this is what it looks like. And you can see that the shares have done really well over the past few months. But if we have a look at Flight Centre and I guess how it trades, it's interesting to see the correlation of the stock price versus the Australian dollar. So if we have a look at Flight Centre's share price with the Aussie dollar, let me just show you how the two trade. I've got Flight Centre's share price on top and the Aussie dollar down the bottom. And if I just merge the two, it's quite an interesting graph. And if I can get it to merge, what you can see is that they both move together. But interestingly, if we have a look at the key drivers for Flight Centre's earnings, one of the keys is international departures, and John O'Shea from Bell Potter has done some interesting number crunching and found that international departures have a one-on-one correlation with Australian GDP, and that's over all time frames in a 1 to 10 year time frame. And if we have a look at GDP numbers, well, we know that they've been quite impressive in Australia. The first quarter GDP numbers have been outperforming expectations. Also, if we have a look at Australian Infrastructure Fund, which focuses in on Australian airports, we know those numbers have been reflective of the positive commentary coming through from Flight Centre as well. So Flight Centre this morning coming out with their earnings guidance, which remains unchanged, and that's for profit before tax of between $270 to $290 million. But what they have come out to say is that it is going to be on the higher end of that guidance. It shouldn't come as too big a surprise. The market consensus is already on the higher end of that range. But altogether, some good news coming through from Flight Centre, especially after some of those cyclical downgrades that we have seen from companies coming out over the last 6 months.
Julia, on the back of that, what about the existing alliance with British Airways? The suggestion is that any tie with the Qataris might straight even break that long-running relationship. Can they afford to lose it?
Absolutely not. And I guess one of the most attractive routes is the Sydney to Europe route, or the Sydney to London route, and that tie-up with British Airways is a strong one for Qantas. And I guess the thing that Virgin has been doing well are these strategic alliances that it's made over the past 52 weeks, and that's really helped it in terms of its business model. So Qantas, at a very crucial time, if we have a look at its shares, it's at a very low price. It's got debt of about $6 billion, but cash of about $3.5 billion. So it's pretty amazing that it's able to pay off around about half of its debt with the cash on its books at the moment. But I guess its business is struggling, especially that international business, and the market really looking for some sort of turnaround over the next 3 years.
Citi has cut its price target on Origin 12% to $16. It's kept the buy rating. Have you seen many other moves this morning?
We have seen brokers coming out with their ratings over Origin because of the announcement yesterday. And Origin is a bit of a strange stock. It trades like an oil and gas stock, but about 70% of its value is actually derived from its utilities business. And of course, yesterday's announcement had to do with the LNG part of its business, the Australian Pacific LNG venture. And in this, it's got a 37.5% stake that it's looking to sell down to around about 30%. And really, we won't get the benefits for this for a couple of years for Origin. So the next couple of years will still be supported by the utilities business before we get that boost from LNG coming in. If we have a look at that announcement yesterday, the sell down stake to about 30%, which de-risks the project and also takes away the risk of a capital raising by Origin, and then that second train as well, has been seen as good news. If we have a look at brokers, the most optimistic at the moment is Macquarie. It's kept its outperform rating on the stock with an $18 target over the next 12 months. The next most positive is UBS. They've kept their buy rating on the stock with a $17 target. We've seen Citi coming out to change its target, and as you mentioned, Brooke, they've cut their target by 12% to $16, but still keeping that buy rating. And we've also seen ratings agency Standard & Poor's coming out, keeping the rating on the stock, but the outlook negative. And of course, the key here, and what the market was also pleased about, is that we haven't seen a blowout cost at this project as yet, but that's one thing that the market will be keeping a very close eye on. So Origin Energy, a bit of a strange stock. It does trade like an oil and gas stock, but about 70% of its value at the moment derived from its utilities business.